Hey, we're live. It is Saturday, November 3rd for a very special live stream. I want to welcome everybody. Thank you for being here, especially everyone in our subscriber community. I'm just loving these live streams and that interaction we get with the community. And we just passed 24,000 people in that subscriber community this morning. So very exciting. And I welcome everybody to, if you're not part of that community yet, to click that subscribe button. It's free, and we're really building a great community of people that want to beat their debt, make more money, and just start making their money work for them. Anybody that's been watching the videos knows that these live streams are usually an opportunity to look back at what we've covered over the last week and answer your questions and get that back and forth going about the week's topics. But this week is going to be a very special live stream. There is a financial crisis in America. 6 in 10 families can't cover $1,000 emergency cost. So basically they have nothing saved. And two in three retirees rely almost completely on Social Security for their income, which that's about it's about $1,000 a month. Even those that are invested in stocks, research from Delaware shows that they're making under 4% annual return on average. That's a stat from over the decade to 2013. The average investor was making about 2.6% on average, and that's from a lot of the fees that we'll talk about and other investing costs, but also a lot of bad investing decisions and just that general stress from stock picking that comes with the traditional returns-based strategy of investing. So that's really what we're going to talk about today. I see some more people joining the live stream. We're just getting started. Welcome. And it's going to be a great live stream. I have a feeling we're going to talk about a new goals-based investing strategy. The first time I'm sharing this is actually the strategy I've used and strategy I've used in the past with private wealth clients. So we know how bad it is for investors out there. But how would it feel to know that your money is there, that working for you, and that you don't have that constant stress of having to pick stocks, of having to feel like you need to pick the right investment? What if your investment strategy didn't depend on finding that next hot stock or even avoiding a stock market crash? I think, which is a very important question considering the October we just had, one of the worst months in the stock market since 2008. So stocks entered correction territory, and it could just get worse. But with a goals-based strategy, that's not something you can avoid. So I want to look at what we'll cover today and share a slide with you here. So we're going to talk about a simple, stress-free investing strategy, and it's one based on your goals. Something that we're going to talk about for basically the topic of the live stream is a major shift in investing from that traditional returns-based investing strategy where you're always trying to beat the market and trying to get as high return as possible to a more goals-based strategy, an investing strategy based specifically on your needs, how to set that up, and what that's going to mean for you. But what I do want to say is, even if you're not sure that this goals-based strategy is going to be right for you, if you want to stick with that traditional returns-based strategy, and you're not quite sure yet, I want you to watch the whole video because you're going to pick up a lot of great ideas on that how of investing. And that's an important idea there, that how. We'll talk about this more later, but investing is built around the what, right? What stocks are you going to pick? What investments are you going to pick for your portfolio? And my work, almost a decade as an equity analyst, and my work with private wealth management has just shown me that what is far less important than you might understand. The how of investing, how you actually set up your investing plan, and how you invest is so much more important. It's going to save you a lot of the fees that a lot of investors get trapped into, and it's actually going to make you a much higher return because you're not worried about constantly picking stocks. You're not worrying about that stock market crash. Within this goals-based strategy that I'm going to talk about, we're going to talk about the 5 lies that Wall Street tells investors. And this is a big one. This is one that I learned while working for venture capital firms and for private wealth management, working for these Wall Street firms, and how really investing has become, I don't want to say, but it has actually become a perversion of what it used to be. And so we'll talk about that. And then we'll go through that process of setting up and managing that goals-based investing strategy. And the great thing about this is it takes very little time. Since you're not trying to constantly pick stocks and pick that next best investment, then it takes very little time and is actually much less stressful. So we're going to talk about how to make your goals real so that they motivate you and to keep on going. We're going to talk about how to make investing personal, how to personalize your own investing strategy, creating your personal investing plan, and then we're going to talk about an age-based investing for every decade. I'm going to walk you through every decade of your life, from your 20s all the way through to your 50s, and then some retirement investing strategies and strategies you can use while investing during retirement. Walk you through each decade there and show you, how to implement this strategy that we're going to talk about. And then I've also got a special offer that I want to talk about later on in the in the webinar. So most of you know me. I spent nearly a decade working as an equity analyst for venture capital. Then I worked for private wealth management as an economist. Degrees in communications and finance. All this, I was really part of that Wall Street machine that we'll talk about, and I think that was really the experience that led me into working with Main Street investors over the last few years with my blogs and with this YouTube channel. And really, I credit my own returns to this goals-based strategy that we'll be talking about today. The S&P 500 has posted an 8.5% annualized return over the last decade. That's including the 2008 crash all the way through this year. But I've been able to book an 11% annualized return over that period because of some of the ideas we'll talk about today. Ideas like not chasing those returns, and a lot of it was really due to not having to worry about that stock market crash. Being positioned in the right investments that didn't drop so much, and really using that how of investing to save my money on the fees and eventually be ready for when the stock market did come up. So 11.5% or 11% versus 8.5% may not seem like a huge difference, but it's pretty nice when you do it every year and it adds up. And what I will be talking about later on in the course is actually the first time I'm offering this goals-based strategy to everyone, offering it in a first launch. And first, I don't want you to think that you have to take this course. This is going to have this webinar, this live stream is going to have everything you need to implement this goals-based strategy. Okay, I'm willing to stay on here for as long as you need. We're going to have Q&A at the end of the live stream, and I'm willing to go back through it and answer every question you have. The course is just for anyone that wants that step-by-step and that personalized help, but it's only going to be open to 10 people for this first initial launch. So I just want to make sure everyone has access to this goals-based strategy through the video here. And the goal is it's 12 lessons, 6 hours of video. So obviously we're not going to be able to cover everything in the course within all the detail in this live stream. Live stream is going to be maybe hour and a half, but I will cover the entire process so you can put it together, and I'll answer any of your questions. The course also includes, budget and income planner. It's really a guided plan from start to finish into this goals-based strategy. I've also got some bonus videos in there, how to get some free money accounts in investing that most people don't use very well, how to invest online, just kind of a step-by-step in there, and then some important bonus reports. But in fact, everyone that's here on the live stream, I'm going to give them a free copy of my 10 steps to avoid investment fraud and a risk tolerance questionnaire that we'll be talking about later. So I've included a link in the video description below to get both of those absolutely free. So I don't want you to think that this is just a sales video. I am going to walk you through everything you need to get started, even if you're not one of those 10 people that signs up for that first initial launch of that course that we'll talk about later. So what we won't talk about this course, and I think that's going to be an important idea in this, is we're not going to be talking about stock picking or timing the market. And the truth is that how of investing, that stock picking, that's the what. That how of investing and this goals-based strategy is so much more important. And to tell you the truth, 99% of the people out there don't need that stock picking. They don't need the timing of the market. It's just going to stress them out. It's going to cause you to spend more money in fees, and it's just going to lose your money. So I'm also going to show you a strategy to have both, though. For those of you that still want to do some of that traditional returns-based stock picking, I'm going to show you how to combine this stress-free goals-based strategy plus the chance to invest in some individual stocks on your own for maybe a little bit higher return. And then, of course, we will have a question and answer at the end of the video. Like I said, I'm willing to stay on here until everybody's last question is answered, and really, have you set up for this, for frankly, what is a really great investing strategy. One that's simple, it's stress-free, it takes less than an hour a year to manage after you've got it set up, and it's going to meet your goals versus this returns-based strategy that just has you spinning your wheels all the time. So I want to welcome everybody. Let's get to the real meat of the course. If you've got any questions, feel free to ask them now, but I'm going to hold all of them to the end of the video. So go ahead and ask them again later on. Now, I want to ask you a question. Have you ever noticed how your financial life doesn't really seem to change even though the stock market's booming? We've had a historic 10-year bull market where stocks have just boomed and some real wealth has been created in America. But for the vast majority of people, it's meant nothing. Their life just hasn't changed over the last 10 years. And it's because Main Street investors are chasing stocks. They're chasing that returns-based strategy, while the wealthy are using this goals-based strategy. In fact, this is something that I developed. This goals-based strategy is something I developed working in that private wealth management. And when you work there with wealthy clients, you realize that it is a completely different investing strategy than maybe what you see or what you hear about on on TV. So that's what we're going to talk about. And it works. It's like I said, it's goals based, so it's specifically focused on reaching your goals. And it's not your fault that you're in this returns based strategy, because this is what you see on TV. This is what you see online, and it's a product of those Wall Street lies that we're going to be talking about next. The financial media actually wants you making these mistakes, while the wealthy people hire people like me to manage their goals. So in fact, a lot of what we've talked about today, I've used that secrets of the goals-based investing strategy that just makes the rich richer, and while everyone else is kind of trapped in that returns-based strategy that you hear on TV about picking stocks and timing the market. So let's get started with these 5 lies Wall Street tells investors. And I'm not going to spend a lot of time here because I want to get into that process. I want to get started, talking about this goals-based strategy. But these 5 lies are very important because they help you see how this returns-based strategy that Wall Street tells you about, that you see on TV, really keeps you spinning your wheels and losing a lot of money. And nobody knows really when Wall Street started these kind of lies. Most people think it's kind of in the 90s when everyone realized they could start getting rich in internet stocks. And investing really became an entertainment industry at that point. All the TV channels, the CNBC, a lot of the online sites, they realized that the vast majority of investors were worth much more to them through those advertising dollars and through those fees than they ever would be actually helping them reach their goals. So investing became that entertainment industry. It became something that that was there to scare you and to keep you trading, to keep you intrigued and entertained. And that first Wall Street lie is really revolves around that. That first Wall Street lie is investing is about stock picking and those huge returns. And it's really not. You know, stock pick, why do you pick stocks? Why do you try to get those returns? You know, it's not just for the sake of returns, it's to make money. And why are you making money? It's to reach your goals. So why is investing built completely around that lie of, you know, it's about stock picking, it's about returns? It should be around your goals, right? And that's really where that idea of a goals-based strategy came from. Creating an investing plan specifically around your goals, so you have a better idea of that you're going to reach your goals, more confidence in those goals. Wall Street lie number 2 is just that you need to listen to these Wall Street pros, Wall Street analysts and that, and this is a bad one because it keeps you going back to the TV channels, it keeps you going back to online. And that just means billions and billions of advertising dollars for them and the fees. If you're relying on these Wall Street analysts to pick your stocks for you, then that really locks you into to using their platforms, to paying their fees. The third Wall Street lie here is just that you need to play the Wall Street game. You need to be in that returns-based strategy. And the reason why they had this is obvious. It's worth a lot of money. It's worth hundreds of billions of dollars in those fees, in those advisor costs, and those trading costs. And like I said, it just keeps you scared and locked into stock picking every single day. Wall Street lie number 4 is you need to worry about a stock market crash. And I think I've shown earlier that with this goals-based strategy, you don't have to worry about a stock market crash, and you can still get a pretty high return and still meet your goals, and it's a lot less stressful. Let me tell you, not having to worry about whether stocks are going up and down because you're not trying to pick stocks. And lastly, the Wall Street lie number 5 is just that you can't manage your own investments. And this is, again, obviously something that is very profitable for the advisor community. I want to show you an example of how important it is for for advisors to have those. Let me see if I can find it here. So say you are investing, you start with a portfolio of $10,000, you invest $200 a month. At the end of 30 years, without any fees, without any other costs, that portfolio is going to be worth $300,000. But if you're locked into this returns-based strategy, if you're chasing those, those stocks and you're paying those advisor fees, most advisors are going to charge you at least 1% a year, 1% of your investments. So of that $10,000 starting portfolio, they're going to they're going to charge you $100 that first year. That's going to stop being your money. It's going to become their money, and they're going to be investing that money for themselves. So at the end of 30 years with an advisor, you're going to see that $200,000, which is isn't bad, and it's something the advisor is definitely going to point out to you. But you just lost $105,000 by buying into that Wall Street lie that you can't manage your own investments. And it is so easy to implement this goals-based strategy that I'll be talking about. It's going to save you that $105,000, and it's going to give you the confidence that really just that your money is going to be there when you need it. So you don't need to pick stocks. You don't need to be in the market all the time. And I know these lies. I've seen these lies because I was part of that Wall Street machine. Like I said, I worked for venture capital firms. I worked in private wealth management. In fact, I set up the sell side department for a venture capital firm. And sell side is just really the department within a financial company that puts together the research that they give out for free. We analyzed stocks and we gave it out for free. Just to get people to buy stocks. This research is designed to get you excited about investing in a specific stock or a specific investment, and to keep you buying. Because really Wall Street's kind of like a casino. They know that if they keep, as long as you keep coming back to buy, they're going to get your money. Whether it's in that advertising that they sell to all the other providers and services, or whether it's just in those fees that you pay in trading or those management fees. So this simple, stress-free, goals-based strategy we're going to talk about right now takes these lies head on with that that shift in mainstream investing from that returns-based to the goals-based strategy that you can manage yourself in really less than an hour a year. So, we're going to talk about, we're going to get started here with this goals-based strategy and why really investors fail with their goals. And honestly, it's because they make these vague goals, right? I actually asked the community last week, why are you investing? And most people said, so I don't have to work anymore. So I don't have to work a job I don't like. And that's great. That's what a lot of people are investing for. And that's a good idea, but it's just so vague. It's is the idea of just not working, or is the idea of maybe paying your college kids tuition, something like that. Is that going to motivate you when budgeting gets tough, when savings gets tough? It always starts with, hey, I'm going to go on that vacation. It's my hard-earned money. I deserve to enjoy it, even if I'm not investing for those goals. And it's because those goals are not motivating enough. So we're going to talk about how to make your goals real, how to really use this start off with this goals-based strategy to make your goals real, to make them motivating, and what we're going to do here, and this is, it might not be the sexiest part of investing, like dreaming about those triple-digit stock returns in the next Netflix, but this is where investing has to start, and probably the single most important step. Obviously, if you're going to be in a goals-based strategy, you need to make some pretty darn good goals, and you need to make them real so that they motivate you when that savings and investing gets tough. So what I want you to do is after this webinar, after this live stream, and take a note of this, is just to sit down with your partner, with your spouse, with anybody that's going to be involved in this in these goals with you, and really talk about those goals. What are your biggest financial goals? And like I said, don't stop at just, oh, I don't want to work, or oh, I want enough money in retirement to live comfortably. You need to create a story around those goals. So talk about it. Even close your eyes and imagine what every day feels like when you've reached those goals. What are you doing? Where are you going? Who are the people around you when you've reached these goals? So you create this mental picture around these goals, and that's just going to be so much more powerful than these vague goals that people have set up, like, oh, I want to make or I want to have $1 million by the time I retire, or I just don't want to work anymore. These creating that mental picture is so important, because when investing gets tough, and you're tempted not to put that money into your investment account that month, then you can take out this mental picture and you look at it and you're reminded how important these goals are to you. And not just for that motivation, but this is also going to give you a better idea of exactly how much you need to reach these goals. A lot of people, they start with a vague idea or an arbitrary $1 million. Well, do you really need $1 million? You might look at $1 million and then use some of these investment calculators and say, okay, well, that's way outside the realm of reason. There's no way I'm going to get there, so I'm not even going to start. What this real goals-based investing does, making that mental picture and making those goals real, is it gives you an exact dollar figure for how much you need in retirement or whenever you meet your goals there. So we've set up our goals, and now what I want to talk about is and you can use any retirement income calculator really out there. This is one that I've got set up in the course, and you can see this actually goes out with the course, and you can see there's all different kinds of tabs here. A budgeting worksheet that you can use, the savings and debts really to really map out your finances, this retirement income estimator, and then we'll talk about these later. These are 14 sample portfolios for every decade of your life. to really walk you through this goals-based strategy. But right now we're going to talk about figuring out turning these goals into how much you need in retirement. And like I said, you can use any retirement income calculator. Basically, you're just going to look at, okay, from these goals, exactly how much do I need to satisfy that daily life that I want. And then you're going to go through here. You're going to put in your monthly expenses. That's going to automatically tell you how much you need per year. You put in your tax rate here, which there's some. It's usually either maybe 15 or 20%. That's going to tell you how much you need before taxes. And then you can decide whether you want to include Social Security in that amount. Now, I'm not going to get into a debate here about whether Social Security is going to be there in 20 years or 30 years, or whether more likely it's going to be far less than what you might think it is. But there's just that option to include Social Security benefits, and then it's going to tell you what the amount you need from your investments after Social Security. And then, if you take that to the conclusion of how much you're going to take out each year, 4 or 5% or whatever that might be, then it's going to give you a specific number that you have to work to. And that's important because, like I said, a lot of people work to that arbitrary $1 million or whatever. And the reality is, I've set this up quite a bit higher, $5,000 a month. Most people don't need that to live on it comfortably in retirement. But so most people need far less. And then you're going to use that number, and you're going to use a returns calculator that we'll also talk to about later to kind of match up your returns, the returns that you might need to some of these portfolios that we'll talk about in this returns-based investing strategy. But first, I want to talk about another idea, and this is all within that topic of making investing personal. Like I said, the vast majority of investors out there are stuck in this returns-based investing strategy. And basically what that means is they're just, getting picking stocks every single day, every single month, trying to get the highest return they can without really understanding, why they're trying to invest, these goals that we're talking about. So when I say making investing personal, I'm talking about making your goals real and then understanding yourself as an investor, because this is going to be very important. In this part, we're talking about your risk tolerance. How much stress you get from investing and seeing the stock market go up and down. And it's another step that is so important, but almost universally neglected by investors. But this is really what a financial advisor is going to do behind the scenes. Of course, they're going to charge you that $105,000 over 30 years of investing, but they are going to look at your goals. They're going to look at your risk tolerance, and they're going to put all that together into actually a kind of a goals-based strategy for you. And that's how they're going to manage their money. Most people don't see that behind the scenes work that the advisor is doing, so they don't realize that that's really how investing is really done. So what we're talking about here is how much stress you feel from investment changes, and really it comes from two factors: your ability to tolerate risk and your willingness. And these putting these two together are going to come down to one of three investor types. You're either going to be kind of a conservative investor that really doesn't want a lot of risk. Maybe you're willing to take 1 or 2% lower return just for that less stress. And that's important. It might sound like you're not reaching for that highest return possible, but if you could put a dollar figure on not worrying about your money, just absolutely knowing that it's going to be there for you when you need it, that's worth a lot, okay? And some people, that's exactly what they want. Or you're going to be an average investor, or maybe even an aggressive investor, depending on your ability and your willingness to tolerate risk. And so your ability to tolerate risk really comes down to your age, liquidity needs, and that's just a technical term, I guess, for when do you need the money, and what stages do you need the money. So if you're a younger investor and you've got decades to retirement, then you've got very little liquidity needs because you don't need the money for a very long time. But with that, you could be a younger investor, maybe with some health problems, or with, maybe his family has health problems or family needs, that you might need that money within a few years. So it's not necessarily just about your age. It's about, when you're going to need the money and all that. And lastly, there is just the size of your portfolio versus your needs also. And this is kind of a counterintuitive one for a lot of people. A lot of people, they don't have much saved for retirement, especially people in their 50s or later that are going to need the money very soon. They don't have enough saved, so their thinking is, I need to take as much risk as possible to catch up really with those returns. And it is actually the exact opposite. If you've got only maybe 40 or 50,000 saved by the time you reach maybe 55 or 60, and you're looking at looking at that retirement needs, the last thing you need is to see a stock market crash wipe out 50% of your portfolio. You actually have a very low ability to tolerate risk. You want to be investing conservatively. You want to be that conservative investor so that your money is there, and we'll talk about different ways to still catch up with your investments and still grow your portfolio, but still be that conservative investor that's going to protect that hard-earned money that you have. Conversely, though, if you've got a very large portfolio and maybe you're younger, then you can take on a little bit more risk because you can afford to maybe see it come down a little bit more with stocks and still meet those goals. And then we have the willingness to tolerate risk. And this is just an emotional idea of how stressed out you get from watching stocks go up and down, right? And this isn't a judgment call saying that anybody that's in that conservative investor type, you're not weak, you're not lazy about investing. That's just emotionally, that's just you're just a better safe than sorry kind of person, So what we're going to do here, and this is usually to find out your ability and willingness to tolerate risk, you take maybe 10 questions. It's called a risk tolerance questionnaire. And this is really going to help you see which of those 3 types of investors you are: a conservative investor, average, or an aggressive investor. And a lot of these are going to be very easy questions, like your age and your time to retirement, how much you have saved versus your goals, maybe your experience in past stock market crashes. And I'm not going to go through each of these questions because, like I said, I'm giving everybody that free risk tolerance questionnaire in the video description below. Just click under the video after the webinar, come back, click through that. And you'll be able to download those 2 free reports, that risk tolerance questionnaire that's going to help you with this risk tolerance and understand what type of an investor you are, as well as those 10 steps to avoid investment fraud. So, after the webinar, download that, and I want you to think through some of these ideas, what you think your tolerance for risk is, and whether you might be that conservative or that average or the aggressive investor, and get that free questionnaire to help you do that. So we're almost done with this part of this Make Investing Personal. This first part of the goals-based strategy. Understanding your goals, making them real so that they motivate you. Then understanding how that works into your tolerance for risk, what type of investor you are, and how much money you need, to retire on or just to meet those goals. I say retirement, but of course it could be just accomplishing your bucket list. It could be doing things that you never thought you could do, and it might just be just not having to work in that 9-to-5 grind that you hate every single day. So then we're going to go to an investment calculator, and this is actually one that I set up on my website, My Stock Market Basics. But you can use just about any kind of investment return calculator. What you're going to do, if you're going to use this one, you go to mystockmarketbasics.com. There will be a menu item up at the top called Investing Calculators, and then you go down to the Retirement Income Calculator. And here it's really just going to walk you through very basic questions. How much do you have saved for retirement already? So we'll put in there, 100,000. What's your retirement goal that you get from one of those income calculators that you used earlier or from the course? And so for that we had 1,085,000. How much can you save each month? Let's say, let's be generous here and say about $250 a month. And we're going to give ourselves 25 years to retirement. Now, this rate of return, you just kind of play around with it. So we're going to say 8% annual return. That's a little bit lower than the long-term average for the stock market. Then you hit calculate, and it's going to tell you at the end of that 25 years, you're going to have that $904,000, or it's going to take you 316 months to reach that $1 million goal. So that's not quite enough. We need to make up a little bit more. So let's go 9%, and then calculate. And there is $1.1 million. So that's pretty close to our goal. So we need somewhere between 8 and 9% return annualized within our portfolio to meet that goal that we talked about earlier. And this isn't necessarily, that you have to reach for that return. This isn't that returns-based investing strategy. This is just something that we're going to use to compare with those, with those. Oh, I just realized I didn't have it on screen when I was using this calculator. Mysteries of modern technology, folks. So like I said, you're going to go to My Stock Market Basics or any investment calculator on the internet. Go to investing calculators up here at the top. It's going to have a retirement income calculator, and then like I said, you're just going to put in your numbers right here, and that's going to tell you, how much your estimated investment value at retirement, your months to reach that investment value. Okay, and again, I'm more ready to go back through this at the end of the video, answer any questions you have about all this. But what you're going to do with this is, we're going to use that to compare against the portfolios that we're going to be talking about later, just to make sure that they're right around the return you need, but also, the type of investor you are, that they're either that conservative, the average, or the aggressive investor, so that you aren't taking on more risk than you need. That's one of the most important things here is you need to invest in a customized plan for your needs and for your personality. Don't be investing too conservatively or too aggressively. You invest too aggressively and you freak out the next stock market crash. You start panic selling, and you get that 2.6% annual return that the average investor gets, which obviously is never going to reach your goals. But conversely, you could also be investing too conservatively. If you're just emotionally an aggressive investor, somebody that can have a little bit higher risk tolerance, and you're investing almost all in bonds, then yeah, you're going to see your investments pretty much just sit there with a very low return. You're going to get bored. You're going to get you're going to get frustrated, and you're going to fall right back into that returns-based investing strategy where you're going to be chasing stocks and chasing higher returns, and then you're going to be at risk for the stock market crash again. And that's that 2.6% average annual return that the average investor makes, that is not making anybody any closer to their goals. So that's the first part of this goals-based strategy, that making your goals real so they motivate you. Figuring out how much exactly you need to meet those goals, using that to find some kind of a return around a return you need, and then understanding what type of investor you are. And I understand this seems like a lot. This seems like it's very overwhelming, but it's not. It's, if you take it step by step, then it is something that anybody can do. It's very easy to set up and get started. And in fact, for the 10 students that are going to start this course launch with me, this very first time I'm sharing this goals-based strategy, I am going to, if you sign up by Tuesday, and I've got a link in the video description below to that course page, and you can even look through a preview of one of the videos and look through the entire curriculum. For anybody that signs up by Tuesday, I'm going to go with you one-on-one through this first part and really show you how to set this up and check your portfolio and help you figure out what kind of investor you are so that you get started right in this goals-based strategy. Next is really, we're going to talk about how to reinvent investing, because we talked about how investing has really become an entertainment industry with that returns-based strategy. Investing for the vast majority of people, investing is strictly about, making those returns and stock picking and being scared about the next stock market crash. We need to reinvent investing into this goals-based strategy. Make it about you. Make investing personal. And so for that, we're just going to cover a few very core concepts to investing. And the first is just going to be diversification. And I know a lot of people have heard about diversification. They've probably talked about it, and maybe you give some lip service to it, but it's something that's very neglected by most people. And this chart does a very good job of explaining diversification. Basically, diversification is just having different investments in your portfolio so that you don't, so that when some are booming and some are falling, then it kind of evens out and you don't freak out. Frankly, you don't freak out over your investments, okay? If a good example of this is if you were investing in the 90s, you were completely in tech stocks, then of course, they lost about 80% of their value over the few years through that crash. So diversification is about having a little bit smoother ride. And this graphic, it just really shows it really well because, if you were exclusively in emerging market stocks, then you went from, being in one of the best groups right here to the next year, the worst group, and then the best group, and then, middle of the road and worst group. But if you had all of these in your portfolio, this real estate, foreign stocks, bonds, U.S. stocks, emerging stocks, then when some did fall like this, then you had others that were going to smooth out your portfolio. So obviously, we see that bonds was the best performing asset class in 2008. Obviously, when stocks are crashing. So in this process, in this goals-based strategy, we're going to be using 3 assets to put together that diversified portfolio for you. And it's going to be very easy because we're going to use some funds to do it. So basically, you're not picking stocks; you're just picking a few funds that cover these sectors and these different assets. So first, we're going to be talking about stocks, and we're going to be getting our stock exposure through the sectors, different sector funds, and I'll be talking about these as well as some international stocks. A lot of people just say that basically they get all their international exposure through S&P companies, through US-based companies that have business overseas. And while you might get some of that, you still need that international exposure because there are so many specific economic risks for the U.S. Within that currency risk, within just specific economic growth that you need to diversify a little bit more. And we're going to show you exactly how to do that. We'll also be talking about bonds and some bond funds that you can use to diversify your portfolio, smooth out that ride, and really put together a more customized plan specific to your goals and your needs. And then, of course, we'll be talking about real estate, adding real estate into your portfolio through those funds, so you're not necessarily having to go and be a rental landlord or anything like that. We're going to use some funds to get your real estate exposure, and frankly, real estate is a great investment because it's kind of somewhere in between that bonds and stocks as far as risk. It's great cash flow, and it's really going to fill in the gaps with that portfolio. So once you've got this diversification or this idea, then we're going to start with creating your investing plan, and this is really what we're going to do with what we do in the course, as well as what we're going to talk about here, because this is going to include everything you need to know to really implement that goals-based strategy. And I'm actually going to share one of the portfolios that we use in the course here, and this is the 20s conservative portfolio. Okay, so this is for someone in their 20s that might be a little bit less risky investor, somebody that doesn't want quite so much risk. And even though if you're in your 20s, you've still got decades until you're investing or until you're needing that money, then you could still be a conservative investor, just in that emotional sense that you don't want to see your investments go up and down with a stock market crash. Okay, you want a smoother ride. You don't want to have to worry about your money, and maybe you have some other expense needs coming up that you need to pay for, and you can't afford that stock market crash. So when we're talking about creating your investing plan, and we'll talk through each decade of your life for this goals-based strategy, this is kind of what we're going to be talking about. We're going to use these 14 funds within stocks, bonds, and real estate to really match these investments with your goals, with your needs, and with who you are as an investor. Okay, and I'll briefly describe some of these funds and how they work together and how you can use them, even if you're not one of those people in that, one of those 10 people in that first launch of the course. But I get a lot of people say, if you've got all these stock funds, basically the whole market of stock funds, why not just invest in a stock market fund? Why not invest in an S&P fund that covers the entire stock market? And really the problem here, and this is something that most people just do not realize, and it's I want to show you something. This is the Spider website. That's sectorspider.com. So sectorspdr.com. I actually talked about this a couple live streams ago, and this is where all of those sector funds, those sector ETFs come from that I invest in, that I use in this goals-based portfolio. And so if you're if you're investing exclusively in a market fund, I want to show you what you're getting. So let's go here. Technology. Okay, so if you're investing in an S&P fund that holds the entire market, 20% of that is going to be in technology. So whether you are an aggressive investor or not, you've got 20% of your money in what is typically a very aggressive sector. The tech stocks, obviously, when the internet bubble burst in 2000, lost about 80% plus of their value. Even in the real estate bubble of the 2008, in that crash, tech stocks lost a lot of money. So if you're just buying a complete stock market fund, instead of looking at these individual sectors to really customize your investing plan, then you're getting mostly tech. You're getting a lot of consumer discretionary. You're getting what's in the market, the entire market. You're getting the market weighting, which isn't how you want to customize your portfolio. So what we're talking about is a customized portfolio where each portfolio is more customized to the type of investor you are. So we have conservative investors here are going to have more in these typically safe sectors, and we'll talk about those pretty soon here. Whereas more aggressive investors are going to have more money in these aggressive economically cyclical sectors. Okay, so let's kind of go through some of these sectors, because I want you to be able to use this goals-based strategy even if you're not part of the of that first course launch. So we've got the XLU, which is just a utilities select sector spider, and that just invests in all the utilities companies, energy, natural gas, that kind of thing. And because these companies are regulated by the government, as far as they've got a monopoly on most of their markets, but they have kind of a limit for how much they can charge according to their costs. It is an extremely safe sector to be in. And we saw that with these safety sectors, this utilities, staples, and telecom. We saw that in the 2008 crash, because these sectors lost much less than some of these other sectors like technology, like industrials and materials. So that's going to be one of our safety sectors. The consumer staples select sector spider, or ticker XLP. Now this is another very safe sector generally, and very high dividend return, so it's very popular among investors. And this is just all the things that you have to buy. This is going to be consumer products, household goods that you use around the house every day and every week. So their sales are very consistent even in a recession. Then you've got the telecom, which actually just changed to a telecom or communication services, but it's still very much that idea of people aren't going to drop their cell phone plan just because of a recession. So these sales for these companies are very much stable. Then we have let's go to some of these more these riskier sectors that maybe the more aggressive investor is going to invest a little bit more in. And these are things like technology, materials, things that generally follow the economy much more closely, that have much more volatile sales than some of these other sectors. Healthcare is here just because of that biotech sector. Generally, other types of healthcare are a little bit more, a little less volatile than you get with the biotech sector. But then with the bonds, to get your bond exposure, these are two funds that I use to get my bond exposure, and you don't need to be buying individual bonds. I get everything I need from these two. The iShares Core U.S. Aggregate Bond, which has about half or 30% of the fund in U.S. Treasuries, so extremely safe, but still enough corporate bonds that it gives you that extra yield, that extra return that you need, as well as high yield corporate bonds, which are bonds of companies maybe a little less financially stable than say your larger companies like Disney and Coca-Cola, but still very safe companies and very safe bonds. And actually within the course packet, the spreadsheet that goes out with the course, which are these spreadsheets, I've got the historical average return for each of these. So you can kind of look and see through each of these how they contribute to your return, how they contribute to your portfolio. So you see in bonds, with this core aggregate bond fund, you might only be making about 4% a year on that historical average, but it's extremely safe. And these bonds, these still made money even in that 2008, 2009 crash. And so this is where a lot of your money as a conservative investor is going to be as we move through those decades of your life. And then the high yield bond obviously makes a little bit more, 6% a year return. Then for our real estate exposure, we're going to be using two funds as well. The V&Q, which is the Vanguard REIT, an excellent real estate investment trust that holds different commercial real estate types throughout the U.S., has returned about 7.6% over the last 10 years annually. And then the Spider Dow Jones Global Real Estate, which just gives you a little bit more international real estate into your portfolio, which is important there. So now that we know which funds we're going to be using to build that custom portfolio that is really based on your goals, not based on just returns. We're breaking out of that returns-based strategy and basing our investing on your specific goals, like we saw earlier with creating those goals and finding out exactly how much you need. Then we've got these funds that we're going to be putting those together, and I'll walk you through. Again, I'm going to walk you through 30s, 40s, 50s. You see all the portfolios here that we'll talk about some of these, and really how your investments change as you age, because that's a very important idea that most people just don't understand. How your risk tolerance changes as you age, how your goals maybe even change as you age, as you get that family and you have different goals, and how that affects your investments and how you need to change those every 5 or 10 years to stay on that goals-based strategy. And that's going to be very important because it's something most people miss. Most people, they're in that returns-based strategy, always reaching for those returns, always trying to pick stocks. They get to, into their 50s and into their 60s, and they're still investing in almost exclusively in stocks for that high return. And then the next stock market crash comes and they lose half of their money. And most of the time they're so frustrated, they're so disappointed and depressed that they've been investing for 20 years and now half of it is gone, that they just pull all of their money out of the stock market. And that's why we have retirees living on basically just on Social Security for the rest of their life. And it's kind of a tragic idea, and it's a tragic fact for a lot of people in America right now. So we're going to talk about how to use this goals-based strategy, how to put these funds together according to your specific needs and your specific investor type, and then how to we're also going to be talking about some of the questions that I've gotten about this goals-based strategy. How to cut your investor fees. We've talked about how much those fees cost. The average investor trades 88 times a year. That's according to Fidelity Investments put out a survey, and the average investor makes 88 stock trades a year. And that's even on the cheapest online platform. That's about $500 in fees. So if you're paying those $500 every year in investing fees, that's obviously money that you're not making money on in the future. $500 a year over 20 years is $10,000. That's with the return that you would have gotten on there, about 8%, that's about $20,000 that you're missing out because you're trading in and out of stocks. You're stuck in that returns-based strategy. So what we're going to talk about here is to avoid those fees. And I know we're using about 14 funds within these portfolios, these goals-based portfolios. And so you're thinking, okay, well, if I'm investing in each of these funds every month, that's a heck of a lot more than 88 trades a year. That's going to be a lot of investing fees. But what you're going to do is, you put money in your investment account each month, but that doesn't necessarily mean you have to buy stocks, buy these funds with that every month. You can wait every 3 months or even every 6 months. It's not going to really matter to your returns. What we're talking about is a much smoother investing policy, or a smoother investing strategy where you're not trading all the time, you're not buying all the time. And actually what you can also do And what I do is within these 14 funds that I have in my account, then I just buy one each month. So 1 month with the money that I put in my investing account, I'll buy 1 or 2 of these funds with that money. And then so for that entire year, I've bought into those funds in the amount that I need. We'll talk about the target percentages we want in these stocks, bonds, and real estate according to the decade in your age, as well as your investor type. And so that's 14 trades a year. So at $5 a trade on some of these platforms like Ally Invest or E-Trade, then that's that's $70. $70 a year that you're paying, and that's it for trading versus that $500 in fees that the average investor pays. So and there's some free trading apps out there, but they do also have some limitations. A lot of them don't have the funds that we're looking for. A lot of the funds that are going to cover you on each of these sectors, they don't have they don't have quite the liquidity. But there's also those options as well. So this is part of that goals-based strategy. Another part that we'll be talking about, and actually this is a bonus video in the course, is getting that free money in some of those accounts like 401ks, your IRAs, Roth IRA. Why everybody should be investing in a Roth IRA. It's not just for rich people. In fact, totally the contrary. Anybody making in those lower income tax brackets absolutely need a Roth IRA, because that's going to give you free tax money, savings in your retirement. You're never going to have to pay taxes on your returns, and that's very powerful. We're also going to be talking about health savings accounts and 529s in that free bonus video that comes with the course. But next I want to talk about, so we've got our investor portfolios, and we'll just go back to these some of these portfolios examples here. And you can see within each, and we'll talk about these in a second, according to your goals, according to the type of investor you are and the stage of your life you are, then we're going to look at, about typically how much you need in stocks, bonds, and real estate. And within that, you're going to break that down into those sectors to really customize your portfolio. And this is an important part here, this percentage of your portfolio you have in stocks, bonds, and real estate. So you see for someone in their 50s that's maybe a less risk, somebody that wants less risk in their portfolio, doesn't want to worry too much about their investments, they're going to typically have around 45% in stocks, 20% in bonds, and maybe another 25% in real estate. And then the rest is going to be kind of in a cash cushion. And that these percentages are important because, as you're investing, especially in a stock market, in a bull market where stocks are rising quickly, then these percentages are going to get kind of out of whack. If you're investing each month according to these percentages, then the stocks percentages of your portfolio is going to be 50 and 55% as stocks take off, and then those bonds, kind of lag a little bit with that 4 and maybe a 5% annualized return. So what we're going to talk about is how to rebalance that, how to keep on these target percentages so that, so that you're not set up for a stock market crash. Because what happens is that if you invest in these funds every month or every few months, then those stocks are going to become a very much larger part of your portfolio. And then what happens when the stock market crashes? If you're 50 years old, you're looking towards retirement, and you haven't paid attention to your stocks, and all of a sudden you've got 55 or 60% in stocks, and then the stock market crashes, and all of a sudden almost half of your investments are out. Half of your investments are wiped out by that stock market crash, and you don't have that time to wait for the stock market to rebound. So what we're going to talk about is called rebalancing, and this is a very important thing that you need to do every 5 or maybe 10 years when you look at your look at this goals-based strategy and you look at your portfolio. And what you're really looking at is how much you have in each of these assets. So stocks, bonds, and real estate. For example, going back to the example here, if you're a 50s conservative investor and you want 45% of your money in stocks, then you're going to look at that and say, okay, just a minute, I've got 55% in stocks. I need to rebalance this a little bit. So there's two things you can actually do. One, you can sell a little bit of your stocks and put that in bonds to bring those percentages back to where you want. Or, and this is actually the less costly thing, is that, you know, every year, every few years, you go back, you look at your portfolio and say, okay, you know, my stocks have really been taking off lately. My stock portfolio is 55% of my total wealth here. So, you know, this new money that I'm putting in every month, I'm going to put that in these bond funds to, you know, increase the amount that I have in bonds and decrease the amount, the relative amount I have in stocks. I'm not necessarily selling any of my stocks, but I'm just getting that protection back in by putting new money into bonds. And this is you know, a great way to be putting money in you know, bonds before the stock market might crash. It's a great way to you know, to be able to have money set aside for when stocks crash, and you can rebalance. Really, the only time you're really going to be needing to sell some investments is after that stock market crash. You can sell some of your bonds to take advantage of those lower prices in stocks. Again, not necessarily to time the market, but just to get these percentages back to where they need to be. You know, you want 45% of your money in stocks as a 50s conservative investor in your 50s. If stocks crash and that drops to, you know, maybe 20-25% of your total wealth, then you need to take some money out to get those reshift those balances. You know, and so here I want to talk about that special kind of hybrid strategy that I talked about, that you know, if you're not quite sure about this goals-based strategy, you still want to invest in individual stocks, then there's a strategy that I use called a core satellite strategy. And this is actually a great kind of mix of this goals-based approach where you're investing in funds with most of your money, but you're still taking advantage of maybe you know, maybe some individual stock picking. So basically what it is you take about 70% of your money, your investable money, and you put that into this strategy, right? You put that into these 12 or 14 funds that cover the stock sectors, the bond sectors, or the bond funds, and then the real estate funds, to give you that goal-based market return that you're looking for. That's you know, specifically designed to meet your goals. And then that other 25 or 30% of your money, then you go ahead and put that into 5 or 10 or even 15 individual stocks that you feel really good about and that you want to invest in. And what this is going to do, it's going to give you that goals-based strategy, but it's still going to let you get maybe a little bit extra return from those individual stocks. Also, since you're not trying to invest all your money in stocks, in individual stocks, then you're going to be forced to pick only maybe the 10 best stocks that you believe in. So it's you know, much less stress. You only need to find 10 stocks that you really want to invest in. Invest that 20 or even 30% at the most in those stocks. So it's a great kind of hybrid, kind of mixed match model of this goals-based investing strategy in funds, as well as that returns-based strategy that most people are more familiar with, and investing in individual stocks. So now I want to talk a little bit about using all this and going through some of those age-based investing portfolios that we use in the course, and that really kind of are designed around your needs. So we're going to go back to these portfolios that we've got set up here, and we're going to start with the you know, start with the 20s. We'll start with the 20s average investor here. So you'll see, you know, an investor in their 20s that has, you know, maybe average risk tolerance, and has gone through those goals, has gone through the return calculator, so they know what return they need. Then generally they might have around 70% of their money in stocks, 10% in bonds, and then 20% in real estate. Now you're going to see a lot of people that say, no, you should have 90 or 95% of your money in stocks. Well, those never include real estate. I'm always amazed at you know, how many people just say stick with stocks and bonds, a 50-50 split or you know, 90-10 split. And you know, it misses a huge opportunity in diversifying your portfolio, plus getting that cash flow from real estate. You know, besides rather other than the last stock market crash that we had in 2008, then real estate has been an exceptionally stable and safe investment compared to stocks. Back in the internet bubble days, when the internet bubble crashed, then real estate did exceptionally well and still provided that cash flow that a lot of investors could use to to take advantage of those lower stock prices. So you definitely need part of your portfolio in these real estate funds that we'll talk about. So if you're a younger investor, so if you're using this 20s portfolio here, then you might have 70% in stocks. And since it's an average risk portfolio, then you're gonna have it pretty much in those all of those sector funds in pretty much equal weights. And remember, this isn't about buying the market. Because a lot of people say, well, okay, go back to that question of why not just buy the whole entire S&P fund? Why not just own the entire market? And again, if you want an equal weighting, in all these sectors, then buying the market fund, that's going to mean you have about 20% in technology stocks. So that's much more than you want for this customized idea, this customized portfolio. So what we're doing is we're buying each sector in equal weights instead of investing too much in any particular sector. And you see that these vary a little bit. For an aggressive investor, you're going to want more in those aggressive sectors, and just the opposite for the conservative investor. But when we go to another portfolio, say we jump to the 40s investor, the investor in their 40s that maybe wants a higher return. And you can see how this has changed. By the time you're in your 40s, maybe you've got a few more goals that you're investing for. Your family is growing, and you've got family-based goals as well. So you shift a little bit more towards a little less risk in your portfolio. And every 5 or 10 years, you take that risk tolerance questionnaire again. You see what kind of an investor you are, and you match up your portfolio with your goals. So here you see we've dropped from about 70% in stocks to 60%. We still have about 20% in real estate, but we've added 5% into bonds, and then we have a 5% cash cushion. And that's just gradually shifting from more risk into less risk and more safer investments. If we go then to maybe the 50s, the investor in their 50s, then we can say we've shifted even a little bit more. We've shifted to 55% stocks. We've added 5% into real estate, and we still have 15% in bonds, and we still have that cash cushion. So it's just very important that you shift your investments throughout each decade of your life to keep on constantly be reevaluating your goals and making sure that your portfolio matches those goals and matches the type of investor you are. And I've got a few other strategies here. I want to real briefly cover some of the retirement investing strategies we've got, and within this this course packet, we've got portfolios examples for every decade of your life, plus some pre-retirement portfolios. But what I wanted to look at here is some retirement, how to invest during retirement. Because I know for a lot of people, maybe you haven't saved quite enough for retirement, and you're obviously trying to catch up, but you're just not sure how to make your investments last while still getting that growth. So here's one of the first approaches we're going to talk about is the bucket approach. The bucket, how to invest in the bucket investing, and this is really dividing your investments up into 3 buckets. The first is going to be your cash bucket, which includes about 18 to 24 months worth of expenses. And this is, this is ultra safe. You can see here money market savings, maybe very short, very safe bond funds at the most. And then, but most of it's going to be in cash, And so this is the money that you have to have there to pay for expenses. You can't get caught up in a stock market crash with this bucket. So you've got 18, 24 months of your expenses in that bucket. Next, you've got your income bucket, which you're going to put 3 to 5 years worth of expenses in this. And this is the primary purpose for this bucket is to make enough of a return that you can refill that cash bucket. Each year, you're going to be using that cash bucket to pay for expenses. So you need to take money out of your income bucket refill your cash bucket so you have a very safe bucket of money, a very safe section of your investments that you can depend on for your expenses. And within your income bucket, you can see that the vast majority is still within these very safe bond funds that are going to be providing a decent cash flow and decent return, but they're going to be safe from a stock market crash. You might have a little bit within these safe sectors like utilities, consumer staples, and telecom that maybe provide a little bit higher return, but are still much more safe than say the sectors, but that are still much safer than some of the aggressive sectors like technology and whatnot. And then, after that, so after you've got your two buckets, 18 to 24 months of expenses in this one, 3 to 5 years of expenses in your income bucket, then the rest of that you're going to put into your growth bucket. And this is just a stocks and real estate portfolio that's going to grow your investments to refill that income bucket. So that's one of the retirement strategies we talk about in the course. We've also got a matching strategy, which is using a bond ladder to actually match your expenses with your match your expenses with your investments exactly. So you've got no fear. You've got complete confidence in in how your investments are going to match your thing. Okay, so I'm seeing that video output is low, a warning from YouTube. So, maintain smooth streaming. So I hope everybody's able to see this. We're almost done, and we're almost to that Q&A section. So get your questions ready, and I'll be answering those very soon. But next, I just want to go back to this special offer for the course, and this is exactly what we've been talking about. This is the first time I'm sharing this goals-based strategy that I developed while working for private wealth management, private wealth clients. This goals-based strategy that gets you away from that returns-based strategy that really gets you away from picking stocks and chasing those returns to a strategy that's actually going based on your goals, is customized for you, and is ultimately going to meet those goals with much less stress and a much more simple fashion. So this is really what's included in the course, and I want to just go over this real quick for 10 of you out there that are ready to get a step-by-step into this and want to take advantage of it. Like I said, it's only open to 10 people, so I wanted to go through the whole process for everyone, so everyone had access to that goals-based strategy. Because not everybody is going to be able to sign up for this course. I'm only offering it to 10 people to get in and go through that step by step to kind of learn how to set this course up. So again, it's 12 video lessons, 6 hours. We're going on almost an hour and a half of the video here. Covered a lot of information, but obviously we haven't been able to cover every single detail of every single step. So that's important. You're going to have lifetime access to this course as well as Q&As with me. So anytime you have a question, I'll be able to help you out. You're going to have those 14 example portfolios as well as the retirement investing strategies that we talked about, the bonus videos, the bonus reports, and like I said, also for anyone signing up before Tuesday or through Tuesday, I'm going to offer that one-on-one review to be able to start your plan. That one-on-one review of your goals, your investment needs, the calculator, and really help you get started on this goals-based strategy. And then, of course, until the cart for this course is going to be open through Friday of next week. I believe that's Friday the 8th. I'm going to close the course. We're going to be offering a third pricing on this first launch. It's going to be $95 to get started for those 10 people this first week. After that, it's going to be, I'm going to raise it to $300 or maybe more. We'll have to figure out that in the future. Now, I'm going to link in the first comment below a free video preview for you to take advantage of. If you want to kind of see the curriculum in the course, see some of the things, some of the detail that what we talked about today, you can actually click through that first comment, watch that free video preview, as well as get some of those other free reports that we talked about. So I'm going to open this up to questions. I appreciate everybody that's been here waiting for these. I know it's a very long webinar, but I just wanted to give everybody the opportunity to use this goals-based strategy. Even if you're not one of the 10 people that signs up for the course, that uses the course, we've got quite a few. We've had a few dozen people in the video, and we'll have a few hundred people watching through this first week. So obviously not everybody is going to be able to be in this course, this first launch of the course. So I just wanted to make sure everybody has a chance to use this goals-based strategy, because this is really a big shift in investing from that returns-based, from that stock picking. So let's open it up to questions. If you've asked a question already during the webinar and I didn't see it, please go ahead and ask the question again, so that I can see it and see, we'll answer your question. I had one question earlier. I do remember, it's why do we need to pay for the course if we just showed us everything we need? And it's a great question. If you're more than happy to go through the video again and really design this whole goal-based strategy on your own. I'm just offering the course to 10 people that want a step-by-step and that one-on-one help from me. It's like I said, it's the first time I'm offering this course, so I'm excited to get started and provide a little bit more detail from what we could talk about in the video. So if you are interested in being one of those 10 people that starts the course, then I'll be leaving a link in the video description below. Go ahead and click through that. Like I said, if you sign up by Tuesday, then you're going to get that free one-on-one planning with me, where I will help set up your goals, help set up your risk tolerance, help you understand what kind of an investor you are to get you started, get started on that course. And then make sure even if you miss that date, make sure you sign up by Friday, because that's when the cart's going to close on this, and that $95 initial price is going to go up to $300. So what else? What other questions do we have? I saw another question. What if the strategy doesn't work for me? What if the goals-based strategy isn't working? And I'd say, it's hard to say that it's going to work for everyone, but because it is a customized strategy, a goals-based strategy, it will work for you. This idea of a returns-based strategy that you see on TV, that you see online, that's really that mass media, that mass market strategy that is the one that doesn't work for everybody. In fact, it works for very few people because you're chasing those returns. This idea of a goals-based, of personalized goals-based strategy, that's going to work for you because it's based on your needs, based on what type of investor you are and exactly how much you need to meet those goals. For those 10 people that actually do take the course with me, then it's a money back guarantee, 30-day money back guarantee, so you can work through a lot of the course there. And if you don't think that it's going to work for you, then obviously no questions asked. I want you to be happy. I want you still to be a member of the community here on YouTube with me. So I'm going to refund your money, no problem, no questions asked right there. So it will work for you or your money back. Do you think planning for inflation should play a role further away from your retirement as well? And yeah, inflation is important, and I've actually got that built into these retirement income tools that I use in the course. Generally, there's two things you can do when you're planning for inflation, and with inflation, we're just talking about obviously if the value of the dollar decreases by 2 or 3% a year, then that might not be a big deal from year to year. But if you're planning your expenses 30 years into the future, then it turns out at about 2%, 2.5% inflation, things double in 30 years. So your normal living expenses might be $3,500 a month each month today. That's going to be about $7,000 in the future. So yes, you definitely need to plan for that, or you can just take it out of the returns that you're planning on making. So for example, if you're looking at your portfolio and you're if you're looking at your portfolio and you're thinking, okay, this kind of a portfolio, one of the portfolios we talked about today is something that's going to get me about 8% return each year, then what you can do actually is just take inflation out of that. Take 2% or whatever you think inflation is going to be. Take 2% out of that and say, okay, I'm getting a 6% after inflation return, and that way you can use the same amount of money, the same estimate for your expenses in the future, but you just grow it by a smaller amount. So great question. Yes, you do need to worry about inflation when you're investing. It's something that we've got built into the course, and something we do within the course. Another question we got, do I have plans for people under 18? We don't. As you saw from the, and I'll go back, but it's something that's going to, well, this is, okay, as you saw from this in the course, we start at the 20s investor, okay? And, I'm going to tell you why that's not really a problem, because, even if you're 15 or 14, you're still going to be pretty close to the needs of that 20s investor, okay? You're going to be investing pretty aggressively. So if you're a 15 to 18-year-old investor, you're going to have a pretty high tolerance for risk. So you're going to find yourself in this, most likely you're going to find yourself in this high return type of investor, this aggressive investor, and you're going to be investing within this portfolio, 75% in stocks, maybe 15% in real estate, and 10% in bonds. And of course, you can shift this a little bit according to your own needs, and that's something we talk about in the course is kind of shifting this a little bit higher or lower. Obviously, you can see that here I've got set up so you can change these percentages a little bit, and they will automatically update your expected return. So if you want maybe even 80% in stocks, then you can change that, change some of these, and it's going to update your estimated return that you can compare against those investment calculators. So we don't have specific portfolios set up for people under 20 years old, but you're going to be using the 20s investor portfolios at first, and then gradually work through it there. It's not going to be a problem. In fear of a stock market crash, would it be wise to reduce stocks and invest more in bonds? If so, what kind of bonds would you suggest? Actually, this is that's kind of that returns based. Thank you, Red Baron. Seen you in the comments. Some of the videos. I appreciate you being part of the community. It's a great question because it's that part of that returns based strategy. It's part of the strategy that so many people use. And it's just timing the market, It's people that, hell, for the last 3 or 4 years, people have been saying stocks are so expensive. Go to cash or go to bonds, and those people have it's basically that 2.6% annualized return that the average investor gets, because people are trying to time the market. They're shifting continuously from stocks to bonds, and not only are they paying those huge fees and those trading costs, is that they are they're just missing out on that goals-based strategy. They're in that returns-based investing strategy, and they're totally missing out on their goals because they're trying to time the market. So I would say no, it's not a time to reduce stocks and invest more in bonds simply because you think the stock market is going to crash. Now, what I will say is that as you're working through these that risk tolerance questionnaire, as you're working through your goals and making your goals real and figuring out how much you need to meet those goals, then if you're worried about a stock market crash, then you're naturally going to come down to maybe a little bit more conservative type of investor. Again, like I said, part of that risk tolerance questionnaire that I'm going to give everybody, you just go to the video description below, you click through that link that I'll set up, and that's going to give you that free handout, that risk tolerance questionnaire to figure out what type of investor you are. That's going to, you're going to work through those 10 easy questions, and you're going to see that, yeah, maybe you're a little bit more conservative investor because you're worried about a stock market crash. And that's going to put you in one of these conservative portfolios that's going to have maybe a little bit more in bonds, a little bit more in real estate, and it's going to be a little bit more diversified, and is actually going to protect you from that potential stock market crash when it does come. Not saying it's going to come this year or next year or even 2020, but it's going to protect you for when it does come. And it's just a much simpler, stress-free strategy because you're not worrying about constantly timing the market or picking stocks. DreadMike73, hey, appreciate you being in the community. I see you in in the community tab and on the videos all the time. Government bonds, yes, that's part of a good strategy. Like we looked at here. I like to look at these funds because they include not only government bonds but also also the corporate bonds that are going to give you the return you need. Matt JT1, do you account for evolving tech and also individual stocks? Yes, that's actually the hybrid core satellite strategy that I talked about that a lot of people still like to use. If you don't want to be completely in this goals-based, fund-based approach, then what you can do is you invest 75% of your money in these funds that are goals based, that are customized, so you have that confidence that you're meeting your goals. But then you take that 20 or 25% that that you can put in individual stocks, maybe get a little bit higher return, but you're not going to be too exposed to a stock market crash. So you're able to invest in individual stocks, but you still you're still in that goals based investing strategy. That's called the core satellite investing strategy. What else? Do we have any more questions on what we talked about, anything on the course or just that goals-based strategy? Again, I don't want you to make you think that this is just a pitch for this new course that I'm launching. Watch through the video. It's the complete process right there. The course is just for 10 people that are going to go through the course with me on a step-by-step. You're going to get some of these bonus, and you're going to get some more some one-on-one review help with me. Any room for foreign bonds? Yes, and actually, if we go back to some of those, portfolios, you'll see that within each of these portfolios, I have developed market fund, an emerging market fund, and I have global real estate within these. And these are in most of these funds. You'll see that according to the needs of that age group. So it's and it's something that I recommend. Something a lot of people avoid or just neglect. They think they're getting plenty of foreign investment exposure within these within their S&P 500 companies. And it's just not a fact. The S&P companies, they're still exposed to the dollar. They're still exposed to a lot of these risks that are specific to the United States. So what you want some of your money in those foreign funds, that global real estate fund, things like that. What else do we have? Any other questions that I missed from earlier? Again, I want to thank everybody for being here. Lydia Santiago, great channel there. Followed yours. Thank you for being in the community. Who else has been on here? Walter and Beja. See, we had some problems with the audio earlier. I hope that's fixed now. But if you've got any questions on the strategy, so what else we have? Okay, how much importance do you place on the country of investment? Would you recommend shifting markets to add crash risk aversion? No, I wouldn't. And again, that's getting back to this goals-based strategy, away from that returns-based strategy. We do have some investment in different countries through those funds, those diversified funds that really spread your foreign stock exposure out and your foreign real estate exposure out. But we're really looking at a goals-based strategy, not a stock picking or market timing strategy. And that's so important because you're going to avoid all the costs, the fees that come with that returns-based strategy. You're going to avoid the stress that comes from that stocks-based strategy, that returns-based strategy, and you're going to have that confidence that you're going to meet your goals. So I want to thank everybody for being here. Again, the course is only open to 10 people, so just this first launch that I'm doing to try it out, give a little bit more one-on-one help with 10 people from the community here. If you sign up by Tuesday, then I'm going to give that one-on-one review to start your plan. If you miss that Tuesday deadline, you're still going to get that $95 course pricing, which is about a third of what it's going to cost after next week. So make sure you sign up. Before Tuesday, if you want that one-on-one review with me, but definitely before next Friday, so you can get that 1/3 pricing for this first launch. Again, remember, click through to the link in the video description below to go to the course. Also, you can click through. If you're not one of those 10 people that takes advantage of the course, you can still click through, get those 2 free handouts, your risk tolerance questionnaire that's going to help you decide what kind of an investor you are, as well as those 10 steps to avoid investment fraud. You can take a free preview of the course. I will be putting that in the first comments below. And again, thank everybody for being here with us on the live stream. If you've got any questions, put it in the comments below, and I will answer every single question that we get in after the live stream. And take advantage to be one of those 10 people in the course to get that started off, and click subscribe, because I love having you in the community. Until next time, thank you, and be watching for that video coming out Monday.